Thank you very much, Jeff, for the introduction, and I suppose given many of you involved in the delivering of water, being in Cape Town was a fairly critical issue. In fact, months out I wasn't sure whether we were going to, D-Day was going to be about when we were there, when there would be no water, or afterwards, but fortunately it was shifted out to July and I'm not sure where it is today. In fact, the day of that incident there was some drizzle during the game and certainly that evening, but that was, yes, certainly, I've got a photograph of Steve Smith walking off the field for the last time after the toss, and I've also got a photograph, I've got a video of him walking onto the field to booze on his last innings, for the moment at least. So. But let's move on and talk about the outlook for the Australian economy and for the building industry in particular, and across the sectors and across the states. What I'd like to do, make sure I've got this right. Okay, good. Press the orange one. I thought that was blocked off, but orange means that's the one we've got to keep pressing. Excellent. So the focus this morning I'd like to go through is some broad comments on the Australian economy, where we're at. We can talk about that for a long time. We can talk about the impact of world economic conditions, but I'll touch on some of those. Obviously, any talk that I do about the building industry comes back to the level of population growth and the underlying demand for housing and how that impacts. So for many here today, it's not just, particularly in the plumbing sector, new housing is important, but the home improvements market's equally important. I've had a long time involved in doing market research studies in the building industry, and particularly in plumbing fittings, and one thing I'd say, whereas 20 to 30 years ago, that was probably one of the most successful areas in terms of the number of companies who were purchasing that particular study, whereas these days there's not quite as many suppliers. And but in many product areas, I suspect 45 to 50% of demand actually comes from that home improvement sector. So it's a very important sector. But population growth and the underlying demand is a critical factor that certainly drives new residential construction and non-residential construction. I'll touch on home improvements and those drivers later. I'll run through our total building, our forecast for total building activity on a state-by-state basis. Is anyone here from Tasmania? Oh, sorry. You'll have to ask me a question. I didn't include the Tasmanian chart. It's actually a very good story. You probably crow every day, once a month, when they put out the latest house price figures that tell you Hobart is the fastest growing place in Australia. And I must admit, I did call that one, but I didn't follow up my own advice in selling out of Sydney and buying in Tasmania, because it's been a good market. I'll give our forecast for dwellings, talk a little bit about alterations and additions, and then finish up with some forecasts for the non-residential building sector. But let's just look at the overall economic forecast. On the table here you can see the forecasts out to 2020. The forecasts that I focus on today is really 2 years out, and you can see the breakdown of economic growth in terms of the key components. If you look at this particular chart, the GDP figure, overall level of economic growth, is the number we all focus on. But generally, in the last 5 years or so, it's really been driven by strong export performance. Obviously, all the mining investment boom that we had, firstly, up to the GFC, up to around 08, 09, was phenomenal. And when that supply came on stream, that really helped our exports. But of course then we had mining boom phase 2, particularly impacting in the iron ore sector, and as a result, when those projects started to be completed, I don't know, 3 years or so ago now, then basically there was a lot of new supply coming on stream, and of course we've also got LNG plants as well. So, while on one hand the mining investment boom, I always look back at it and say it didn't do a lot for Australia if you were based in Sydney, and to a less degree Melbourne, but if you were based in Sydney, because up to 2012 it felt like we were in a recession, nearly a depression here in New South Wales. But certainly, and with a very high percentage of all the equipment and all the building of those particularly the LNG plants, a lot of that came in from overseas. It didn't really impact significantly on the level of economic growth, because while we saw very high levels of business investment, we unfortunately saw very high levels of imported equipment coming in as part of the development, particularly of those LNG plants. But we're now seeing the benefits of those completed projects resulting in very strong export growth, which you can see there has been sustained generally at 5-6% for certainly the last 6 or 7 years, so very strong performance. If you actually go above the line there and see G&E, which is gross national expenditure, that's the level of expenditure that's going on in the country before you add in exports and subtract imports. Those numbers are not particularly flash. There's a number of years there where the growth rate's only around the 1% mark, shot up to 2.4% last year, and is up to 3% this particular financial year, 2017-18. So it's really been the growth in exports that's driven overall growth. In terms of the looking at some of the other drivers, private consumption expenditure has been modest. We've had fairly weak wages growth for a number of years now. That doesn't look like changing. We would expect that in the next 12 to 18 months there will be some acceleration of wages growth, but we're not talking, it's sitting around 2%. It might get up to 2.5%, but it looks like it's still a few years away before it might get to 3%. So certainly, that weakness in wages growth is basically impacting private consumption expenditure. And I think it's a reason behind why, generally speaking, over the last 5 years or so, home improvements expenditure hasn't been flash. It's been modest, the growth in that sector. A bit better last financial year, not too, the current financial year, but generally speaking, as you'll see later in the charts, and while that's published alterations and additions figures, that is projects that require council approval, and of course most kitchen and bathroom renovations don't require council approval unless it's part of a major house addition, so therefore most of that information isn't reported. I still think these figures probably reflect the general view, from what I understand talking to major manufacturers or people in the distribution business, is that this is not a market that's been roaring along in recent years, and I think that's reflected, say, in the general private consumption expenditure. Private investment numbers, obviously you've had very weak business investment in recent years, though there's a bit of a turnaround at the moment in non-residential building and plant and equipment investment, but it's really been the strength of residential building that's helped private investment numbers rise in recent times. But if we move forward, that growth rate will start to slow while we're getting into a downturn in terms of new dwelling starts, because there's so much high-rise activity out there at the moment, and those projects will take projects are still relatively strong at the moment in terms of commencements. We're not going into a big downturn in the residential building sector over the next 12 months or even 18 months, as you'll see shortly. So overall, economic growth is likely to sit still around that 2.7 range mark this year and next year, and maybe back to only 2.5% GDP growth in 1920. So it's modest growth rate. I think it's what you'd have to class as the new normal. Those of us who lived through the 80s and 90s, I suppose, and even the first half of the 2000s, probably expected in the good years we'd be doing around 3.5%, maybe even 4% at the peak of an economic cycle. But I think when you look at the fact that the Australian economy has not had a recession since 1991, it's not surprising that if you don't have the you don't have the booms, and then you don't have the busts, basically, and therefore it's a steadier environment. And as someone who's been forecasting in this industry for coming up to over 38 years, in fact now, from an initial time at James Hardie, I must admit I prefer these days to some of the past experience of the 82-3 recession, or 1991, or even 2001 when the GST came in. So we're used to some pretty dramatic cycles, whereas we're in a much more stable environment, and even the story today probably isn't as pessimistic as I would have told you a year ago because of the strength of population growth. So overall, in terms of economic growth, the world economy is fairly strong. Might slow a little bit from the current sort of peak levels of growth, but overall economic growth worldwide, despite the fact that we have a lot of dysfunction in politics around the world, I think, not just here in Australia and the US, but really in most Western countries' politics. I see the Italian, they may form a government in the next few days in Italy, which I suppose what's new there in terms of forming governments. So the world is in an interesting place that despite those uncertainties in the political scene, economic growth is relatively strong. And in that environment, that's obviously good news for our exports, despite the issues that might be out there in terms of trade restrictions. If you look at a breakdown of economic activity on the investment side, and this is purely private investment, it doesn't look at public investment. Actually, I think I can just go back. If you look at public investment in the previous chart, it's actually been doing quite well, quite strong numbers in recent times. I'll talk a little bit later about education, health, building and some of the other government areas of expenditure, but generally public investment's been quite strong. But on the private investment side, you can see there the numbers for new dwellings, so very strong over the last 3 to 4 years. Some slight slowing, I mean really modest weakening in activity this financial year and next. Remembering that dwelling commencements peaked really back in the year to June 16. I mean it's a good 21 months since new dwelling commencements peaked, but because of the fact that in the detached housing sector there really hasn't been any significant decline, the decline started to occur in high density apartments, but of course the long lead time for completion means there's a lot of activity in the system from a work done perspective. Non-dwelling buildings have been relatively weak in recent times, but started to turn the corner and will grow quite strongly in work done terms this financial year and next. There's two indicators we always look at. We either look at commencements to understand what's coming into the level of activities out there in the marketplace, but in terms of if you're in the building products supply business or you're a contractor, your business is really relating more to the level of work done, which is the level of expenditure that's actually occurring at any point in time. And when you get big projects like hospitals that cost $1 billion or the Adelaide Hospital $1.8 billion, you know, analysing commencements is probably a fairly meaningless figure in terms of relating it to the level of real activity out there in this particular year or that particular year. You can see the engineering sector, just how big a decline has been in that sector. That's really coming to the end of the decline. Obviously, the big thing in the engineering sector is a lot of road construction, some of that public sector, some of it private sector, so it's a mix. And obviously, in some cases, you know, things like West Connex will be it's a public road, but ultimately it'll be sold sometime in the near future, or 50% of it, somewhere close to 50%, to a private organisation. But in terms of the statistics, a project like that would be measured as public sector. Plant and equipment investment, as I said, starting to turn the corner, stronger growth coming through this financial year and over the next few years. So that just gives you a bit of an understanding. I suppose I should just make a couple of other comments in terms of exchange rate. We don't see a lot of change on the exchange rate over the next few years. 76 to 78 cents generally against the US dollar is where we would see. So from an exchange point of view, we don't see massive fluctuations against the US dollar. In terms of interest rates, in that environment, clearly with wages growth not taking off, with the level of economic activity sitting more around the 2.5–2.8% range, we really see the outlook as being pretty steady on interest rates. In fact, for over 12 months we've been saying that potentially rates would not rise until the end of 19 or 2020. We've sort of been in that December quarter 19 or March quarter 20. At the moment it's officially our forecast is December quarter 19 next year, but I suspect we could well in the next month in fact change that to somewhere in the first half of 2020. So we don't, I mean that's good news for the industry because we're not going to see significant rises in interest rates anytime. In fact, not just in the next 2 years, but if those rises do start to come through late next year or 2020, you may only see a 0.25% rise initially, and it might be 9 to 12 months before the next rise, because residential construction will be coming off. That'll be acting as a negative on the economy, and there just won't be enough other things happening out there or enough wages growth to really stimulate economic activity. And clearly, while there might be some tax cuts coming through, let's face it, they will not be of magnitude to put a lot of extra dollars in people's pockets. So the story on interest rates is a pretty stable environment, so that's good news. With inflation only getting back towards 2.5%, so the mid-range of the 2 to 3% band that the Reserve Bank targets in 18-19 financial year, and a similar figure in 19-20. So we do not see interest rates as a critical factor. Markets will be more driven by whether they're in oversupply or undersupply. Okay, for someone who's forecast for just short of 40 years, I always followed interest rates because, finished university just as inflation was taking off, or it was taking off in the mid-70s, and basically for the next 20 years we lived in a fairly high, well, to the early 90s, a high inflation period, but we've been fortunate since then that inflation's been sustained at lower levels, and while we thought interest rates were significantly lower when they were at 7.5%, clearly at 5.2% for the standard variable, that's a very attractive rate. And of course, with discounts, people are getting down to 4.5% or even less. So the interest rate environment's not one that's going to be a critical factor driving the industry. Let's move on and talk about population growth and, first of all, net overseas migration. So you can see on this chart here, if we look at the cycle in terms of the level of net overseas migration going back over about the last 25 years, it used to be we'd get about 100,000 people into the country per annum. That was a pretty good sort of number. In fact, if you went back to the 80s and 70s, it was probably more in the region of about 70,000 per annum. And then we got to a point where it was sort of sustained in the 90s at around the 100,000 plus or minus. And then it skyrocketed with the mining investment boom when we started to get it's okay? No, it's okay. I should have said, please, Jeff didn't mention turn off your phone. He told you where the exit was in case the 747 came through. I forgot to remind you about about your phone. When we saw all those people starting to come in on long-term visas to work here for 3 or 4 years with the mining boom, sort of 05 to 08, 09. Also, we were getting a lot of students coming in at the time. We hit 300,000 people in 08, 09, okay? Phenomenal increase. It dropped back, and there was a lot of, we got our name in the media a lot around the 2010 election. Julia Gillard even quoted B.I. Shrapnel, and Kerry O'Brien used a lot of our information to quiz Tony Abbott on 7:30 one evening, and we were predicting that there would be a significant fall off from that level because the coalition opposition were trying to portray the fact that we were running too high a level of immigration. Interestingly, when you look at the numbers I'm about to show you. Anyway, it got back to about 170,000 in the trough, went up again, and then dropped back. But this time it didn't drop quite as low, and dropped back a few years ago to about 180,000. But at the moment we're back up at about 250,000 people coming in per annum. Now this is not 250,000 permanent people coming in here. That's no longer the critical factor. The critical factor is really the number of people that come in on long-term working visas, student visas, or people on holiday visas. Anytime your receptionist or some general admin type staff goes on holidays and you need someone to come in, who do you tend to get? You tend to get some Irish, English backpacker who spent a few months, because that's how the system works, up on fruit picking or whatever it might be, and then they come to the big smoke and try and get some work here. So that's where migration is these days. So, you know, maybe when you're talking around the barbecue about immigration, and I'm sure it'll come up in the next election, and there'll probably be some people in the room who support Dick Smith's view on immigration. I'm not one of those. And is that basically immigration today is not about the permanent people. That's a factor, but you know, the government says they're bringing about 180,000, 190,000 people per annum in terms of the permanence. But the biggest factor and the biggest swing variable in terms of these movements in the last 10 to 15 years is in the people who are coming in here as students, working visas or holiday visas. And also New Zealanders from time to time who don't require a visa. But of course, their economy's been strong in recent years, and so they haven't been coming in the same sort of numbers. In fact, for a while there, maybe people were going to New Zealand to help out with the rebuild of Christchurch. So certainly net overseas migration we've changed our forecast only in the last number of months, and we think out to 2020 it's still going to sit around that 235, 240,000, dropping back from the 250,000 peak. So immigration again is a positive factor for underlying demand, and while it might drop back beyond that, our forecast is still that it's going to sit around that 200, 210,000 mark, which is well above the long-term averages, and that will drive stronger underlying demand. Where do those migrants come? Well, if we turn the clock back up to 2000, they used to come to Sydney in a big way. 42%, I think, at the peak came to Sydney. And then, as you can see there in that particular chart, when there was a lot lower proportion numbers of people coming into the country, but then at 300,000, New South Wales was only accounting for around about a third. So, Bob Carr said the place was full, and basically everybody responded accordingly, and New South Wales took a lower share of the population inflow from overseas. WA saw a massive increase in the inflow, massive. Went from about 15, 17,000 people per annum to over 40, and then with the second mining investment boom, sort of around the 2011, 12, 13 period, it went up to about 50,000 plus. Massive flows into WA, accounting for, I think, 20% of the population inflow. So these are the factors that have driven the industry, really. Those huge flows in, massive impact upon residential construction in WA back at that point in time. But then look at where WA's gone. It's gone back to about 12 to 13,000 and absolutely plummeted, and residential construction's fallen by 40+%, basically since the peak of about 3 years ago, 3 and a bit now maybe. On the other hand, and Queensland's a similar story, but it didn't get the boost from mining boom phase 2 because coal wasn't really having a big impact in terms of investment at that time. Its strength was more in the earlier boom that ended around 08, 09. And so there's been huge drop-off in the proportion of people coming into both Queensland and WA over the last 3 or 4 years. And correspondingly, New South Wales and Victoria have taken a higher proportion of the inflow. And really, that's the simple fact behind why New South Wales and Victoria has been where all the action has been across residential building and non-residential building over the last few years, basically. This is the number one factor. And our view is, it won't change dramatically. There'll be a little bit of a drop-off, and of course, Queensland and WA will start to do a bit better, but they're not going to recover dramatically, but they will improve from the very low levels of the last year, and you'll see that modest pick up there, as you can see in the red and the green line, out to 2019-20. So in proportionate terms, there's a bit of a drop-off in New South Wales and Victoria, but in a long-term sense, these are still very high numbers of people coming into New South Wales and Victoria. On the interstate migration, I always used to say, I think it was when I was at James Hardie back in the early 80s, just looking at these numbers, I used to think they were critical numbers in understanding cycles. I reckon if you, back then, nowadays it's the net overseas migration that's more critical, but back in the 80s and I think into the 90s, if you could predict the movements in net interstate migration, I reckon you could predict the property market, because those booms, look at Queensland in the past and pre-2000, it was even greater. Look at the numbers of people who are flowing into Queensland, and conversely they were leaving New South Wales. In recent years, the population movements between states have been less since the GFC, but we're just into obviously the weakness of things in WA meant that people no longer went to WA, which had obviously been quite strong during the mining boom. Queensland hasn't been the flashiest market in recent times, and not surprisingly, that economy hasn't attracted interstate movements. But it started to turn in the last 12 or 18 months and is risen from very low numbers of only 6,000 or 7,000 back up to about 16,000 or 17,000, and we'd expect it to get up, maybe even towards 30,000 over the next 2 years or so. That'll be at the expense of New South Wales. Historically, more people who come in from overseas to New South Wales just means that some of the existing residents decide that with the cost of housing, with the congestion and all the rest, and I think that issue of congestion might be on the front page of a paper today, eventually some people decide, well, I don't like this anymore, I'll move to another state. And so at the moment there is an increasing outflow. One, some people are obviously capitalising on that massive increase in their house price, and for the younger people are basically deciding they just can't afford to get into Sydney and they need to move elsewhere. So generally speaking, there will be a pickup in outflow from New South Wales. Victoria is a standout. It's the place that has done better than anywhere over the last 20 years, from being the basket case through the early to mid-90s. It's not just been phenomenal in terms of the population inflow from overseas, but look at the numbers even on net interstate migration, getting up to 16,000 to 17,000 per annum, whereas turn the clock back 10 years or so ago, I think I dropped something off, 10 years or so ago, and basically, sorry about that, using my hands. That's some Italian influence of my wife, I think. Then basically, if you turn the clock back, basically Victoria's just turned around dramatically. They used to be losing people on net interstate migration. In fact, there was a period back in the 90s where they lost 30,000 in 1 year, and then got back to about zero, and then it just kept on increasing in recent years. So these population movements are dramatic. If we turn our attention then to overall population growth, you can just see how strong Victoria has been. The old days it was WA was the standout, or even Queensland, particularly in the past. But now, for a long time, Victoria has been the standout with the fastest growing population. Probably over the next 4 years, we will see WA and Queensland return to their more normal positioning of strong growth, but certainly nothing like they were in those earlier years. New South Wales will ease back a little bit from around that 1.5% growth rate back to about 1.2%. But still, for a first world country, these are high rates of population growth. There's not too many places around the world of Western countries that are enjoying such strong population growth, and I suspect basically if we look out the next 10 to 15 years, it will still be very positive. Looking at the population growth by age group, this is actually quite important also, not just in terms of understanding new housing demand, but understanding what sort of housing demand will happen, and also home improvements activity, because one of the problems with the ageing of the population, and there's a bit of ageing around the population, I suspect here, is that fortunately people still replace their kitchen and bathroom, though males probably like to postpone the replacement of the kitchen and bathroom. I think our kitchen's coming up to 20 years, and we've been in the house about 32 years, I think, and so you can see even after that yellow Formica that was there from the late 70s when we bought the place. It took till about 97 or 98, I think, before we replaced the kitchen, so I resisted for a long time, but the kitchen still looks pretty good. But I think amongst people 60 plus, you're still going to replace kitchen and bathrooms. But if you're dependent upon the house additions market, that is not a growing sector, because people, one, we're getting less houses built, so there's less opportunity to add on to an existing house, because a higher proportion of people in Sydney and even eventually in Melbourne will be in medium or high density dwellings. So certainly home improvements activity relating to additions and other such work generally are not a fast growing sector. In fact, some of them will decline over time, I suspect. But kitchen and bathrooms, whether you're living in an apartment or a townhouse or a house, we'll continue to see, I think, the typical 15, 20 year replacement cycle, or maybe partial replacement. I suppose the more important question is, if we get a higher proportion of renters in the market, and that's been the reality for the last 5 years, then home improvements activity is less. And I think that's a factor behind the weakness in recent years, because we've seen a decline in home ownership, and investors are less likely to do those renovations to the same degree that owner-occupiers. So when you look at the age structure of the population here, you see that generally in recent years the level of growth in the key age group probably for home improvements activity, that is 35 to 49, I think that historically is when people do a lot of activity. That's been a fairly weak growth sector, well below the overall population growth, probably not much more than about, 0.5%, 0.4%. The good news is over the next 4 years that is actually going to rise. So it's going to get back to around the normal growth rate for the overall population, that is around the 1.5%, 1.4%. So that's good news, because it probably means that people in that age group are more likely to do certain types of home improvements activity. On the other hand, the ageing of the population, 60 plus, is still by far the fastest growing age segment, or 65 plus, and clearly that's not good news in terms of drivers for demand, probably for home improvements as well as for new dwellings. On the other hand, first home buyers, a segment of the market who have been out of the housing market for most of the last 5 years, except 5-6 years, but have started to return in New South Wales, buying established dwellings thanks to the changes on stamp duty and also other benefits which have been taken away by this government back in 2012. New South Wales government and Victorian government particularly. So, but over the next few years there will be less growth coming through in that first home buyer segment. So if we look at overall level of underlying demand for dwelling in this particular chart, you see that we're likely to talk about underlying demand being 198,000. Now this is a hot off the press number. It has not, we haven't actually published this previously, so it is our latest number that we've just reviewed. That'll be in our long-term Building in Australia report due out in about 4 or 5 weeks' time. So we were saying only 2 months or so ago about 190,000, and we've raised that to 198. Okay, so very strong underlying demand. Now remembering we peaked at 232,000 back in 15-16, and we're still building over 200,000. So you can't keep building above underlying demand without creating an oversupply. So there is an oversupply in some markets. So it's important to understand that. Clearly, Victoria is the standout. Average underlying demand for the next the 5-year period to 22, we've got there, the current year and the next 4 years, is 61,000 dwellings. New South Wales still at 55,000. So that population outflow and net interstate migration is clearly leading to some softening in the New South Wales numbers, and why they will be less than Victoria. So, and Queensland's still relatively strong at 43, but pretty much in line with current numbers. As you can see there, what this means is New South Wales will start to run down its huge stock deficiency, which was massive a few years ago, and that will still be significant. So it's not like the market in New South Wales is going to oversupply. No, if you looked out at Walleye Creek or Green Square and other places around Sydney, you'd say, surely this is a market going into oversupply. Now, there may be some pockets, but overall, basically, we will still be undersupplied at the end of this cycle as they complete all these projects. That's our current view. Simply because investors have walked away from the market, developers are struggling to get projects off the ground at the moment, and as a result, we will see a 40 to 50% decline in high density commencements here in New South Wales or in Sydney, and similar sort of numbers, maybe even a bit worse in Melbourne, and in the case of Brisbane we've already seen a 50% plus decline in high density apartment commencements. So the correction will come through, and that correction will be good news in terms of, whereas probably a few years ago we thought markets like Melbourne would be severely oversupplied for a long time, we don't see that now because 1, stronger population growth, and 2, some sort of corrections has started to come through. But in the case of Brisbane, I hope you didn't buy a Brisbane apartment in the last 2 or 3 years because those inner city apartments are massively oversupplied and will be for another couple of years. In terms of the other markets, WA, you can see they're severely oversupplied, and it's going to still take another few years to run down that excess supply. Queensland did move into some oversupply, mainly in that inner Brisbane apartment market, and Melbourne, or Victoria, as you can see there, still remains undersupplied. And even Tasmania, a market that 2 years ago we would have said was in oversupply, on the latest census data and other indicators, we've now reviewed those numbers and they are basically undersupplied. Northern Territory's not unlike WA. The impact of the mining boom has meant that that market's in oversupply. Just some of the other indicators to show you that the markets are still generally, like Sydney and Melbourne, remain undersupplied, is vacancy rates in the order of 2–2.5%. A 3% vacancy rate for rental accommodation is typically regarded as a balanced market. Brisbane had been in oversupply, that's sort of moving back towards balance, but just remember in Brisbane, there's a big difference between that inner, within 3 or 4 k's of the CBD and sort of moving out from there. And of course, Perth, massively oversupplied. That's what happened. Sorry, I missed. There we go. Perth, massively oversupplied, okay, but starting to see some improvement, okay, but it's got a fair way to go yet. Let me quickly go through some of the numbers. I'll just give you a bit of a top-line flavour. I've sort of covered some of the key issues. If we look at overall building activity, it's still fairly good news. Obviously, this financial year, growth on top of last year, and further growth expected of about 5% in 18–19 before a bit of an easing as the downturn starts to gather momentum in the residential building sector. But remember, this is in commencement terms. In terms of work done, you're probably not going to feel too much pain in 19–20. There'll be still enough work in the system because of that high density apartment construction. It will be still driving the numbers. The good news, as you can see there, is non-residential buildings start to come through in 16–17, and that's going to be very strong growth this financial year and in June and into next year, which means that sector is going to be doing very well from a work done perspective over the next couple of years. The story's not dissimilar in New South Wales and Victoria. If we look at the New South Wales numbers, just look how long it was through the 2000s of just how weak that market was. It was going nowhere for a long period of time, and if you actually, if you looked at the cycle and obviously in comparison to 2000, it was a fair way below where it was in 2000. But we've been into a strong growth phase over the last 5 years, and that growth, while starting to peak, we are talking about modest declines from this very high level of activity. So we're only talking about 3 or 4% decline per annum this year and over the next 2 years. And that's going to come from that weakness coming through in the dwelling sector, and I'll talk about that in terms of the components more shortly. But a very strong upturn coming through in non-residential building, particularly in office construction, in hotel construction, and also to a degree also in retail. This current financial year there's been a huge increase in retail building commencement, so that'll keep the industry busy for some time. Victoria, on the other hand, is, that's been the strongest state. As I said, if you looked over the last 15 to 20 years, it's been the strongest performing state. And while we thought it was pretty good, even in the post-GFC period, how it survived that downturn, it sort of was only a blip on the radar there around that 2010–13 period, but since then it's just gone from strength to strength. Overall building activity being driven both by residential construction and non-residential building. Now it'll start to come off, so we are looking at a 13% decline in 18–19. Now, some of the latest numbers, there's been a bit of a surge in recent months in apartments. I don't know whether it's the last fling, basically, because certainly the fundamentals wouldn't suggest that high-density apartments are going to be sustained. But so I'd expect there to be a pretty significant correction coming through, particularly in 18–19. Non-res, well, that's just surged over 16–17 and 17–18, and while it will drop off, this is still operating at a very high level, and again, to move from commencements to work done will highlight continued very bullish activity. Queensland, on the other hand, has been a flatter market. Obviously did very well up to a year or so ago out of this boom going on in high-density apartments in the inner Brisbane area. I think they went from something like 3,000 apartments a year to about 15. Totally unsustainable. And now that market, as I said, has come off 50 to 60%. So that's what was driving the numbers up to 15, 16, but you can see dwelling construction started to ease. And it's all in the apartment segment. And also, there's big differences between parts of Queensland. Obviously, Gold Coast, Sunshine Coast generally doing a lot better, even in the apartment market, but generally detached housing, as you'll see later, doing reasonably well. Non-residential, not as good as New South Wales and Victoria, but certainly will pick up quite strongly in 18, 19 we've got there. Turning our attention to South Australia. I didn't comment on the South Australian numbers earlier, but basically very low population growth, not a lot of people coming in from overseas, and continues to lose 3,000 or 4,000 people per annum moving interstate. So in that sort of environment, it's a pretty steady sort of unspectacular story. You can see the impact of Royal Adelaide Hospital back a few years ago, 4 or 5 years ago, into the commencement numbers. And while the numbers from that low post that project have picked up, it's certainly not, nothing phenomenal. And certainly in the residential sector, we expect fairly flat to modest declines over the next few years. WA is getting into the end of the downturn in the residential sector. You can see how the blue line, how significant that has been, and we would expect that that's coming towards the end, and as a result, things will start to flatten out. But there were signs that late last year that it was starting to move into recovery, but I think that was a bit of a false-lived view, and in fact we've cut our numbers back again, probably on what we've even got in this chart. And the non-residential, sectors affected by massive oversupply of offices. We're talking somewhere in the region of 25% vacancy rates. Just a few comments. I think I've touched on most of these factors, but basically the critical factor for residential is really the degree of oversupply that exists in some markets like WA. On the other hand, effectively the strength of the population growth in Victoria over the last 5 to 7 years has just prevented that market going into oversupply, and there's little risk that that's going to happen now. And but overall, total population growth is going to keep residential construction in the medium term, like going out 5 years, at significantly higher levels than may have been thought a few years ago. One of the factors that's happening at the moment is we're transitioning away from, obviously, a market that was heavily driven by investors, and we're starting to see more owner-occupiers come back into the market, particularly first home buyers. So the growth rate from first home buyers in New South Wales is about 70 to 80% this financial year, and we'll be seeing the best level of activity in that sector for about 6 years. Foreign buyer demand is falling off, and we'd expect that basically that's in response to the increased significant tax charges by state governments, and also issues around restriction of lending to overseas buyers and tighter capital controls in China. Just overall, in terms of property prices, everybody likes to always hear the property price story. We predicted about a 3 to 5% decline in the Sydney residential market over a 12 to 18 month period, and it looks like we'll be down at least 4% year end of June. So that's come through pretty much as expected. I suspect in the next 12 months it could drop another couple of percent. Melbourne maybe will hold its own or grow a couple of percent, but the boom days are over and not going to return in the next 3 or 4 years, would be my comment. Where's the next boom? Hard to tell at the moment because the pressures aren't building in markets like Brisbane to justify a boom. You've got a massive oversupply in apartments, but you've probably got a fairly balanced market in housing. So I don't see that, those spruikers who are sort of encouraging people to move out of Sydney and buy in Brisbane, forget it at the moment. I think you've got a little while longer. And Hobart, look, it could go for another 12 months, but the fundamentals aren't that brilliant that that market is going to be sustained. You know, a 3-year upturn, if it goes another 12 months, would be a pretty good performance. And Perth, they're coming to near the end of the downturn. Prices are down about 12%. Prices do fall sometimes, and Perth's coming towards the end of the downturn. Canberra's quite strong. It's doing reasonably well at the moment. So just quickly going through some of the dwelling charts, and I've commented on a lot of the numbers along the way, but just to give you an idea of the magnitude. So this financial year we expect dwelling commencements to finish at about 219,000. They'll only be down 1% on last year, and remembering the peak of 2 years ago of 233,000. For those who have been around in the industry a long time, you know, first of all, you would never have believed anybody who told you we'd go to over 200,000 starts, let alone going to 233. But if you did at least say that was a possibility, you probably would have thought the next trough would have been an absolute diabolical downturn. And here we are, nearly 2 years on, and we've only come back by about 7%. We still think we'll be still operating at relatively high levels of about 192,000 dwellings in 18-19, but that would be down about 12% in commencement terms, and down about a further 9% in 19-20 to about 174,000, which, if the trough's 174,000, we used to think that was a peak. So it's a pretty good number. But as you can see, there are big differences between the sectors. If you're exposed to detached housing, it's pretty much steady as you go. Though we might have taken the numbers back in the last few days a little bit. We're still just finalising those numbers. We're a little bit worried about some of the signs of land sales dropping off, but given the magnitude of the delay in terms of from sale to registration of land, I suspect there's enough activity in the market for certainly the rest of calendar 18, or even the early part of 19. But the downturn in 19 and into 20 could become a little bit more severe than previously thought, based on that drop-off in demand for land sales, which will drive the detached housing segment. One of my worries is basically maybe too high a proportion of investors have been buying up land in recent times, and therefore, if that's been the case, now investors are starting to get worried about whether there's future capital growth in this market, whether we're talking Sydney or Melbourne. Maybe that'll just lead to less new investors buying up land, and therefore less new detached houses being built. And of course, first home buyers aren't buying a lot of new dwellings, they're mainly buying established dwellings. That's where the recovery's happening in that demand since the change in the stamp duty. The drop-off in demand will be in attached dwellings, the multi-res segment, and massively more in the high density market than medium density. Just look at the boom nationally that's gone on in high density. We're talking 75,000 dwellings at the peak. It used to be less than 20,000. Okay, talk about dramatic change. Who would have ever thought that would happen? In fact, a few years ago, someone when I put the New South Wales chart up, you'd say there wasn't sites that were available. They wouldn't developers wouldn't get approval, but it's happened. Obviously, as someone who depends on the industry, you probably sort of support it, but on the other hand, you don't want it in your own backyard, right? That's one of the problems. But the downturn is going to continue to be heavily concentrated in that high density segment, not in the medium density. The medium density will come off, not dissimilar to housing. It'll be a more gradual easing back in activity. In New South Wales, you can see there significant declines starting to come through, but again, a more modest decline in detached housing than in medium density. And that's the high density number. So New South Wales isn't quite as bad as, say, Queensland or Victoria, but you'd be still looking at least a 50% decline, somewhere close to a 50% decline. Without investors, I mean, the problem will be, of course, and this is where government policies, state governments putting on tax charges on investors, increased stamp duty charges, etc. That's all good and fine in a boom to maybe discourage speculation, but there will be a time where we need investors again in the market. and that's probably 3 years away from now. So when no one wants to invest in residential because there's not price growth potential, it'll turn. Just like 2 years ago, people kept asking the question, how long can this boom keep going? And it just kept going. Now it's over, we're into a price decline, sentiment's changed dramatically. We will need some stimulus that gets investors back in the market, because the reality is, while there might be some improvement in first home buyers at the moment, the reality is we are in a long-term decline in home ownership levels, is my belief. Just a quick look, the boom has been very concentrated in detached housing in Sydney, not so much in regional areas, but that'll probably turn towards the end of the forecast period, and the growth will be stronger in regional areas as the downturn takes further hold in Sydney. So, and that's a similar story in probably other parts of the country. In Victoria, you can see just how big a boom this has been, gone from 40-odd thousand to sort of 70,000 dwellings, or close to it, and we are looking at, in fact, this financial year will be the record level. We thought the record was in 15-16, and then it dropped back in 16-17, but we'll finish at about 72,500 starts. Phenomenal. The downturn may not be necessarily quite as severe as that. There's some potential upside risk, I suspect, more upside risk on Victoria in 1920. If you look at the split again, there'll be a massive drop-off in high-density apartment construction in Victoria over the next couple of years. If we look at Melbourne versus the rest of Victoria, again, totally driven by Melbourne. The rest of Victoria has been relatively weak, but again, thanks to some government stimulus, etc., that market might start to improve in 1920. Turning our attention to Queensland, that boom, as you can see there, was not a house-driven boom. It was a high-density apartment-driven boom, particularly in the inner Brisbane area. And really, the numbers in detached housing are relatively modest growth or small declines. There's not big movements happening out there at the moment in that sector. But on the apartment front, you can see how high-density construction just absolutely skyrocketed, and now it's fallen through the floor. It'll end up being down about 70% at the bottom of the trough in a couple of years. Medium density, on the other hand, is sort of moving up and down a bit, but the declines will be much more modest. And then again, not quite a significant difference between the metropolitan area of Brisbane and the rest of state in comparison to, say, New South Wales and Victoria, where it was all Sydney and Melbourne driven rather than regional. That difference is not quite as great in the detached housing market for Brisbane versus the rest of state. South Australia, pretty modest levels of activity, not a lot of growth happening out there at the moment. And WA, well, you can see how big the decline has been from 32,000 starts in 14-15. Activity will be back to less than 18,000 this financial year. And really, we don't see much of a recovery coming through over the next couple of years. Now, let me finish up with a few comments on the alterations addition sector and then on non-res building. In the alterations and addition sector, as I've touched on some of the factors, alterations and additions activity tends to historically have had a fairly strong relationship to real estate markets. Stronger real estate market price growth typically, and also turnover, means that turnover of real estate typically means a few years down the track people are more likely to do renovations or add on to the dwelling, whatever it might be, a few years after they've moved in, and also people feel better about adding on if there's price growth in the market. But really, particularly in the case of Sydney, that hasn't happened to the same degree as previous cycles in the last 30-odd years. And I think a critical factor is, one, the shift to a higher proportion of rented, investor-driven market rather than owner-occupier, and secondly, the ageing of the population, and thirdly, and probably the most important factor, for the last 25 years, 50 to 60% of construction has been in medium or high density dwellings. and those offer less opportunity for renovations activity. So I think those factors are behind the fairly weak view, and you can see the numbers have generally done better in Victoria than New South Wales, like every other indicator over the last 15 to 20 years. They've done better, and you can see in New South Wales, yes, it's picked up in recent times a little bit, but not phenomenal growth rate. I think the home improvements market, I'd be happy to take some questions on this, but I think generally speaking it's underperformed compared to what people might have thought 5 to 10 years ago, and I think it's for the reasons that I've just stated. And so really we don't expect, we'll see stronger growth in markets like Queensland that have been weaker in recent years. It's the old story. The longer you stay weak, eventually you turn the corner and you get some growth back in there. And relating back to population, and where there is more detached housing, unlike New South Wales. And just a few comments about non-res building. That sector started to really pick up strongly. It started probably 4 years or so ago in the hotel building sector, but also in the last few years a lot of office construction, and that sector's got a few more years to run because we've got we're moving to low vacancy rates in Sydney and relatively low rates in Melbourne, but of course go to WA or even Brisbane and generally vacancy rates are at a fairly high level. Hotel construction's probably moving towards the peak in the cycle, but again, all these sectors, I'm talking commencements, and then therefore in terms of when the plumbing fittings go into a project, there's going to be a lot of activity in these sectors for the next 2 to 3 years, effectively. If we look at you can see social institutional, but let's just go to some of the sectors. Well, first of all, let's look at the states. Again, same story, and it comes back to population growth. New South Wales and Victoria are the standouts. Queensland's starting to do a lot better in moving into 2018-19. WA, obviously a weak market because of oversupply and much lower population growth. And South Australia, well, not a lot can be said. Sorry to say. What someone say to me the other day, they went to Kangaroo Island, or they went to South Australia for a holiday. It felt like 2 weeks. It was a week. Sorry, I shouldn't say that. I'll get thrown out. Let's have a quick look at the sectors. You can see office construction, just how strong it's been. Okay. Interesting, not as strong as what it got to in the 07 and 08 period. Not a time when New South Wales was participating in a boom, but certainly phenomenal level of construction going on in Brisbane, Perth and also Melbourne at that particular point in time. But still, we're looking at very high levels and being sustained out to 2020. Retail construction's picked up a bit in recent times, otherwise it had generally been in line with the sort of flatter private consumption and retail sales activity. Accommodation gone through the roof, very, very strong numbers. But will start to fall off in 1920. And then the other sectors, obviously health building has been relatively strong for a long time now, and again, that looks like, while that's softened in recent years, that sector's about to surge again. And aged care continues to be clearly a growing sector. I love these articles. They talk about things in the budget about the baby boomers. People realise baby boomers aren't exactly moving into aged care for another 15 years. Well, maybe 10 to 15. Most people move into aged care post 80. Only a small proportion of people go in before 80. And what the oldest baby boomers have just turned 70 in the last year or so. So it's still quite a long time off yet before you get the massive surge of baby boomers impacting upon aged care. And education, which obviously surged with the building education revolution around 09, 10, 11, and generally it's been weak in recent years, but that education sector's, again, has picked up strongly in the last 12 months or so. And entertainment and recreation will get a surge from one new stadium at least, it would appear, here in New South Wales. I gather there's a race to get the thing demolished, so it has to be built before the election in late March next year. So I think that just sort of finishes up my presentation. So in summary, we're still looking at relatively strong levels of activity for the industry over the next couple of years. Yes, from a dwelling commencement viewpoint, activity will continue to weaken, but there'll be a lot of work in the system because the downturn will be concentrated in high density construction. Probably in 1920 you'll start to see a bit more of a weakness in detached housing, and obviously the alterations addition sector will grow at sort of modest rates and fairly strong activity out of non-residential building. I'd be happy to take some questions. Come on, yes.
We have a microphone.
Talked about the
Do you want to get the sound recorded?
renovations, alterations, additions, and a bit of an issue in that
Yep.
kitchens and bathrooms aren't reported. So those numbers that we saw, is that missing people that, because you
Yep.
renovate, you're not reporting?
No, it's not in the Bureau of Statistics numbers, but since 1987, BIS has been doing surveys of consumers to estimate the home improvements market in the non-reported market. And so we would estimate that market to be about, and we don't count painting and some of the other related type of minor works as part of it. We're talking about structural related work through everything from kitchen bathrooms, which are two of the biggest markets after the house additions, fencing, reguttering, window replacement, re-roofing, paving, decking, you name it. There's about 20 odd projects that we analyse. We'd say the market's probably worth a bit over $40 billion in total, and so that's the only way we get an insight. In fact, the Bureau of Statistics buy our information to help them feed through to their dwelling investment figures so they can understand the reported part of the market's probably only about a fifth of the true size of that. It's probably reporting at $7 or $8 billion, the reported part, which is the only indicator we've got on a month by month, quarter by quarter basis. We used to do surveys about every 18 months, but since the GFC, lack of industry support has probably has pushed those timelines out. So we did a major one in 2010, and we did one again last year. We did a smaller one around 14, I think it was, and then one last year. But we used to have data points every 18 months to estimate this market, so we had a pretty good feel for what's happening.
What we saw before, could we times that by 5? So it's
Basically, yeah, if the figure was showing around $7 or $8 billion, and I think it was, let me just double check. Yeah, around just under $8 billion, you could multiply it by about 5. Yeah. And trying to estimate what is a kitchen renovation or bathroom renovation, we define by what people put in it. If someone says, yes, I've done a kitchen renovation or a bathroom renovation, you then say, well, okay, did you replace the cupboards, bench top, put a new sink in, put new floor down? You go through everything, and then basically the same for a bathroom, you go through all the plumbing fittings. And in very simple terms, what people might class as a kitchen or bathroom renovation, about 2/3 of them are what you might class as a full job. Yes?
I see Queensland just recently hit 5 million population, but with cities in the south of Brisbane, like Logan, with Yarrabilba and that, they're planning, Logan City Council told me, for 1 million houses to go into that region. 1 million houses, 3.5 million people, that's significant over the next 30 years.
It won't be over 30 years, it'll be a lot longer than that. That's typical council type stuff. That would not be, it's people building up the growth in an area. I hear those numbers from time to time, and typically they're exaggerated. Look, Queensland will probably in the long term grow at maybe 1.7% per annum. Sorry, my calculator in my head's not going that quickly over 30 years. If it went from 5 million to 8 million in 30 years, 3 million in total. 3 million, that's about 1 million houses. I mean, in fact, on our numbers, I'd say Queensland in total needs about 1.3 million houses, 1.5 maybe. So there won't be 1 million houses in Logan, I can tell you. Any more questions? Yes.
You made the comment earlier regarding your thoughts that you see a long-term decline in home ownership.
Yep.
Do you ever see that turning around?
No, I mean, the reality is, I've been shocked that it held up at sort of close to 70%, maybe a little bit less here in Sydney, for such a long period of time when, you know, as I said, in my nearly 40 years in the industry, debates about home ownership levels, declining affordability have been there for a long period of time. I mean, we had 17% housing interest rates in 1989, and there was a housing summit that Bob Hawke called in Canberra, and we went and saw Nick Reiner and talked about issues at that time. These things have been around for a long, long period of time, and I suppose what I've said over the last 2 years or so publicly is, for me, this is a more substantial, sustained, and one downturn in home ownership levels that wasn't going to be quickly turned around. And while in the short term we're getting more people out there buying at the moment established dwellings in New South Wales, thanks to the change on the stamp duty and the government grant being available to those people rather than only for new dwellings. And by the way, I used to always support that maybe they should favour new dwellings, but this exercise has certainly proved that that's bad policy, because, you know, particularly in a place like Sydney, 85% of people, first home buyers, are going to buy an established dwelling. They can't afford to buy a new. And why should they buy a new? Because, you know, if you go around this area here and look at apartments, typically they'll have a 20% premium over an established apartment. Why? You shouldn't be encouraging a first home buyer to be doing that. It doesn't make sense. I think we are into a permanent decline, and I don't think governments will be able to turn that around unless you're prepared to give up a 20% drop in the house price. Volunteers?
No, not me.
Yes.
Rob, when do you see an impact from the second Sydney airport, and particularly on non-residential?
Oh, look, if it's going to open around 2026, 2027, we'll wait and see. I live in the west. Might even be affected a little bit by planes getting somewhere close. I reckon around that period of time leading up to it, I mean, it's not going to come massively ahead of it, because it's not going to suddenly happen, but I reckon in that, certainly that 2025 to 2035 period is going to be a period of strong growth for the west and out in those areas. I think it's probably great news, and I mean, I live close to the M7 out in the west, and you think of what the M7's done for the whole opening up of warehouse space in those areas. It's been phenomenal and highly successful and better located than the old days when it was sort of all the action was somewhere close to around here. It's great, I think, for the development of Sydney and development of Western Sydney. So I'd be fairly bullish if its impact over that 10 to 20 year period beyond that. One last question. You can ask about the cricket if you want it. Excellent. Thank you very much.